January 9th, 2026, a date the financial world will remember. Silver crashes below $80 per ounce in 48 hours. But this isn't what it seems. After breaking a 40-year pattern, after 150% gains in a single year, something else is happening. China's exchanges hit their lowest inventory in a decade, 772 million ounces. American banks are divided. Some predict $65, others warn of $175. But on January 9th, the market sent a signal most investors missed, a structural shift that could reshape the next decade of global commerce. The question isn't whether you're prepared. The question is, do you understand what's actually unfolding beneath these numbers? Welcome to Currency Analyzer. Now, before we dive into this critical analysis, let me ask you something. You remember when information was hard to come by? When understanding markets required decades of experience and the right connections? Those days taught you something valuable. That real wealth isn't built on hype. It's built on informed decisions, strategic positioning, and understanding what others overlook. That's exactly why this channel exists. If you appreciate economic analysis that respects your intelligence, if you value facts over sensationalism, if you understand that knowledge is the only real currency in uncertain times, then do yourself a favor. Click that subscribe button. Not because everyone else is doing it, but because you recognize the value of strategic insight, the kind of analysis that helps you stay ahead, not catch up. And while you're here, drop a comment below. Tell us where you're watching from. New York, London, Dubai, Singapore, Mumbai. Because what's happening in silver markets right now, it affects every corner of the global economy. And your perspective matters. Now, let's talk about what January 9th really means. On January 9th, 2026, silver traders around the world opened their screens to a number that made them pause, $77.72 per ounce. It wasn't the highest price silver had ever reached. It wasn't even close to the December peaks. But something about this specific moment felt different. Just 48 hours earlier, on January 7th, silver had been riding high above $80 per ounce. Investors were celebrating. The metal had completed a 3-day rally that seemed unstoppable. Then, suddenly, the momentum broke. Silver dropped below $80. The financial media called it profit-taking, traders cashing out after extraordinary gains. But experienced market observers knew there was more to the story, because silver hadn't just moved a few dollars. It had traveled an incredible journey. 12 months earlier, in January 2025, silver was trading at $30 per ounce. Steady, predictable, boring even. By December 2025, it had reached $77. That represented a 157% increase in a single year. Some investors made fortunes. Others watched from the sidelines, convinced they had missed the opportunity. But January 9th suggested something else entirely. This wasn't an ending. It was a beginning. For 40 years, silver had been trapped. Financial analysts called it the $50 ceiling. Every time silver approached that level, it would crash back down. In 1980, it briefly touched historic highs during a speculative frenzy. Then it collapsed. The memory of that crash haunted silver markets for an entire generation. The 1990s came and went. Silver stayed low. The 2000s brought a commodity boom. Silver rose toward $50 in 2011, then collapsed again. The 2010s saw another attempt, another failure. By 2020, most serious investors had accepted a simple truth. Silver was trapped. It would never sustain prices above $50. The market wouldn't allow it. They were wrong. In 2025, everything changed. October 17th, 2025, marked the breakthrough. Silver exploded through 54.46. The 40-year ceiling had shattered. For the first time since 1980, silver was trading in genuinely new territory. Trading floors erupted in activity. Risk managers scrambled to adjust their models. Because if silver could break $50 after 40 years of failure, what else was possible? The rally didn't stop at $54. By December, following a Federal Reserve interest rate cut, silver pushed through $64, then $70. By year's end, it was trading in the $71 to $72 range. The third quarter of 2025 told the most important story. Silver closed Q3 at $46.64. This became the highest quarterly close in silver's recorded history. Not a momentary spike, a sustained, confirmed quarterly close. That number represented something profound. It meant institutions, not just speculators, were holding silver at elevated prices. It meant pension funds, sovereign wealth funds, and major banks believed these prices were justified. But the real story wasn't just the price increase, it was what was happening beneath the surface. For 5 consecutive years, the world had consumed more silver than it produced. In 2025 alone, the deficit reached 63.4 million ounces. Forecasts for 2026 showed the deficit would continue, but perhaps narrowing to 30.5 million ounces. This wasn't a temporary supply disruption. This was a fundamental mismatch between what the world needed and what the world could produce. Mine supply was falling, not because companies didn't want to produce more, but because most silver comes from mines that primarily produce other metals. A zinc mine produces some silver as a bonus. A gold mine yields silver as a byproduct. When silver prices rise, these mines don't suddenly produce more silver. They produce more of their primary metal, and silver output barely changes. Meanwhile, demand was exploding. Solar panel manufacturing had become the single largest industrial consumer of silver. The global push toward renewable energy meant billions of solar panels being manufactured every year. Each panel required silver for its photovoltaic cells. There was no adequate substitute. Electric vehicles were the second massive demand source. A traditional car might use 15 to 18 grams of silver. An electric vehicle used 25 to 50 grams. Some luxury electric models used over 100 grams. Then came the data centers. The artificial intelligence boom of 2024-2025 created unprecedented demand for computing power. Every AI model required massive data centers. Every data center needed thousands of servers. Every server needed silver for connections, switches, and thermal management. The analysts had predicted January 9th would bring silver to 77.72 with a potential high of 81.61 and a possible low of 72.83. They weren't guessing. They were reading signals that most people couldn't see. The US dollar was strengthening. American economic reports were due any day. The Federal Reserve was about to make decisions that would affect every market on the planet. And more than 80% of market experts believed the Fed would hold interest rates steady. No cuts, no increases. Just watching and waiting. But Fed Governor Stephen Moran had said something interesting just days before. He mentioned the central bank might need to cut interest rates aggressively to keep the economy moving forward. His words created ripples across trading floors from New York to Hong Kong. January 9th wasn't just another trading day. It was a signal, a warning, an opportunity, and the world's most sophisticated investors were paying very close attention. There exists a phenomenon in financial markets that reveals more than any single prediction ever could. When the world's most powerful banks cannot agree on a number, something fundamental is shifting. In late 2025 and early 2026, Wall Street's titans were not just disagreeing about silver, they were publishing forecasts so wildly different that they couldn't all be right. And that disagreement told a story more important than any consensus ever could. Bank of America shocked the market first. Their analysts raised their 12-month silver target to $65 per ounce. Not a modest increase, not a conservative adjustment, a bold declaration that silver would climb significantly higher from its already elevated levels. They pointed to narrowing real yields and strengthening ETF inflows as their primary justification. In the banking world, this was aggressive positioning. Conservative institutions don't typically predict 50-60% increases in commodity prices unless they see something compelling. ING, the Dutch banking giant, took a different path. They predicted silver would average 39.75 per ounce in 2026. Their reasoning centered on stable global growth and steady industrial demand. They were the optimists who believed the world economy would continue functioning normally, supporting moderate silver prices through traditional demand channels. Then came Scotiabank. Their forecast stunned market observers. They projected an average of just 33 per ounce for 2026. While silver was trading above $70, Scotiabank was predicting a collapse back to the mid-30s. They saw modest recovery in manufacturing and continued ETF inflows, but nothing that would sustain elevated prices. Either they knew something others didn't, or they were about to be spectacularly wrong. These weren't small differences of opinion. These were fundamentally opposing views of reality. Bank of America saw $65. Scotiabank saw $33. The gap between them was nearly 100%, but the real drama was happening outside the major banks. Keith Neumeyer had been preaching a different message for years. As CEO of First Majestic Silver, one of the world's primary silver producers, he believed silver could hit $100 per ounce, maybe $130. His reasoning was simple but provocative. The market was structurally undervaluing silver relative to its scarcity and industrial importance. Neumeyer wasn't just talking. His company produced the metal. He saw the supply challenges firsthand. He knew how difficult it was to increase production. He understood the geological constraints that limited new discoveries, and he was convinced the market hadn't priced in the coming supply crisis. His supporters wore T-shirts that read triple-digit silver. They attended conferences, they posted online, they built a movement around the idea that silver was heading far beyond $100. Critics called them dreamers, conspiracy theorists, people who didn't understand basic market dynamics. But then came Alan Hibbard from goldsilver.com. Hibbard made Neumeyer look conservative. He predicted silver would perform better in 2026 than it did in 2025, better than a 157% increase. He publicly stated he wouldn't be surprised to see silver increase by over $100 per ounce, reaching $175 or higher. That wasn't a forecast. That was a revolution. If Hibbard was right, silver would be trading at prices never seen in human history. Adjusted for inflation, even the 1980 peak hadn't reached those levels. This would be genuinely unprecedented territory. Other American voices joined the chorus. Some analysts predicted $70 to $80 as a reasonable 2026 range. Conservative, but still implying strong performance. Others saw $85 to $90 as a realistic short-term target, with $100 as the major psychological barrier. A smaller group of technical analysts looked at the 40-year cup and handle pattern and calculated targets between $250 and $300. They acknowledged these numbers sounded insane, but they pointed to the mathematics of the pattern and insisted the projection was valid. The Federal Reserve sat at the center of this debate. America's central bank held the key to silver's future, whether they acknowledged it or not. Their decisions on interest rates directly affected silver prices through multiple channels. Lower interest rates weakened the dollar. A weaker dollar made silver cheaper for foreign buyers, increasing demand. Lower rates also reduced the opportunity cost of holding silver, which pays no interest or dividends. When bonds paid 5%, investors had to think twice about silver. When bonds paid 2%, silver became more attractive. The Fed had cut rates in late 2025, helping push silver to its December highs. Now, in early January 2026, markets were pricing in more than an 80% probability that the Fed would hold rates steady at their next meeting. But Fed Governor Stephen Moran had complicated matters with recent comments. He suggested the central bank might need to cut rates aggressively to sustain economic momentum. His words created uncertainty. Would the Fed cut? Would they hold? Would they surprise markets with a rate increase if inflation resurged? Nobody knew for certain. Meanwhile, the Fed's balance sheet was expanding again through something called the reverse repo program. Technically, this was just a liquidity management tool. The Fed insisted it wasn't quantitative easing. It wasn't money printing. It was just technical operations to keep markets functioning smoothly. Many analysts weren't buying that explanation. They saw the program as stealth quantitative easing. More dollars in the system, more liquidity available, more potential inflation pressure, and all of that supported higher commodity prices, especially precious metals. The US dollar index had fallen below 99, a psychologically important level. The 10-year Treasury yield was hovering around 4.6%. These weren't just numbers. They were signals about America's economic trajectory and monetary policy direction. Political dimensions added complexity. Chairman Jerome Powell's term was scheduled to end in May 2026. The Trump administration had made clear its preference for lower interest rates. If Powell was replaced with a more dovish chairman, someone willing to cut rates aggressively, silver could surge. Conversely, if inflation forced the Fed to remain restrictive despite political pressure, silver might struggle. The American perspective on silver in early 2026 wasn't unified. It was fragmented, contradictory, and uncertain. Major institutions disagreed by factors of 2 or 3. Industry insiders saw triple-digit prices, while banks predicted corrections. This disagreement wasn't weakness, it was information. When the smartest analysts in America cannot agree on silver's direction, it means the market is genuinely uncertain. And uncertainty creates volatility. Volatility creates opportunity. The question for January 9th and beyond wasn't which forecast would prove correct. The question was, what would force resolution? What event, what data point, what policy decision would break the stalemate and send silver decisively in one direction? American markets were waiting for an answer, but the answer might not come from America at all. China doesn't announce its plans. It executes them. While American analysts debated on cable news and published contradictory reports, something was happening in Shanghai that would change everything. The numbers appeared quietly on trading screens in late 2025. Shanghai Futures Exchange inventory levels, the lowest since 2015. Most traders scrolled past this data point, just another statistic in an endless stream of market information. But a few observers stopped. They recalculated, they checked historical records. Then they realized what they were seeing. Physical silver was disappearing from Chinese vaults at an unprecedented rate. This wasn't a temporary dip. This wasn't seasonal variation. This was systematic depletion of metal from one of the world's 3 major silver trading hubs. Someone in China was buying silver, and they weren't selling it back. Lease rates in Shanghai began climbing sharply. In commodity markets, lease rates measure the cost of borrowing physical metal temporarily. When these rates spike, it sends a clear message. Owners of the metal are reluctant to lend it. They're holding it for a reason. Physical delivery challenges emerged across Chinese markets. Traders who bought paper contracts and requested actual metal found themselves waiting. Sometimes weeks, sometimes longer. The paper market and the physical market were diverging. This was a dangerous sign. It suggested underlying stress in the supply chain. It meant the contracts trading electronically weren't fully backed by metal sitting in vaults ready for delivery. China's industrial demand explained part of this phenomenon. Chinese manufacturers dominated global solar panel production. Not participated in it, dominated it. More than 80% of the world's solar panels came from Chinese factories. Each panel required silver paste for the photovoltaic cells. There was no adequate substitute. Silicon-based solar technology was fundamentally dependent on silver. As China expanded its renewable energy capacity domestically and exported solar panels worldwide, its silver consumption grew exponentially. The government had committed to massive increases in solar power generation. Those commitments translated directly into silver demand that had to be met regardless of price. Electric vehicle manufacturing told a similar story. China produced more electric vehicles than any other nation by a wide margin. Every EV required 25 to 50 grams of silver for sensors, battery management systems, and high voltage wiring. Luxury models used even more. As China's EV production climbed from millions to tens of millions of units annually, the silver requirements became staggering. But industrial demand alone didn't explain the inventory depletion. Something else was happening. Russia had provided the template 1 year earlier. In a watershed moment for silver markets, Russia announced a multi-year plan to accumulate $535 million worth of silver for its strategic reserves. This was the first time a major central bank had openly added silver to official reserves in the modern era. The precedent was set. If Russia could designate silver as a reserve asset, so could others. China watched carefully. Chinese authorities never confirmed or denied any official silver accumulation program. No press releases, no government statements, no public announcements. But market observers noted the pattern. Consistent buying, declining inventories, rising lease rates, physical shortages. The fingerprints of large-scale strategic accumulation were visible to anyone looking closely. The gold-to-silver ratio provided another clue about China's thinking. Historically, this ratio had fluctuated between 40.1 and 60.1, meaning it took 40 to 60 ounces of silver to equal the value of 1 ounce of gold. In recent years, the ratio had climbed to 80.1 or even 90.1. This suggested silver was significantly undervalued relative to gold. Chinese investors understood mean reversion. They knew that extreme ratios eventually corrected. If the ratio returned to 60.1 or 50.1 and gold prices remained strong, silver would have to rise dramatically. This created a compelling value proposition for long-term accumulation. The production ratio told an even more interesting story. For every 9 ounces of silver mined globally, approximately 1 ounce of gold was produced. The mining ratio was roughly 9.1, yet the pricing ratio was 80.1 or higher. This disconnect suggested either gold was overvalued, silver was undervalued, or some combination of both. Chinese analysts had written extensively about this discrepancy in financial journals. They argued that if silver were priced according to its relative scarcity in production terms, it should be worth significantly more. This was theoretical, of course. Markets don't price assets based purely on production ratios, but the analysis planted seeds. It created a framework for understanding silver's potential upside. China's data center expansion was accelerating faster than most Western observers realized. The country was investing hundreds of billions of dollars in artificial intelligence infrastructure. Every AI data center required massive amounts of silver for servers, cooling systems, and power distribution networks. Unlike consumer electronics, which could sometimes substitute cheaper metals, data center specifications demanded high reliability materials. Silver's superior electrical conductivity and thermal properties made it irreplaceable in critical applications. As China raced to achieve AI supremacy, its silver consumption for technology infrastructure surged. The contrast with American markets was striking. While U.S. institutions published conflicting forecasts and debated monetary policy nuances, Chinese buyers were simply acquiring physical metal. Less talking, more action. This created a feedback loop that intensified with each passing month. As Chinese buying removed metal from global markets, inventories fell. As inventories fell, prices rose. As prices rose, more attention focused on silver. As attention increased, more buyers entered. The cycle reinforced itself. By January 2026, the global silver market was effectively split into two worlds. The paper market, where contracts traded electronically and prices fluctuated based on financial factors. And the physical market, where actual metal moved from sellers to buyers who intended to hold it long term. China operated primarily in the physical market. America dominated the paper market. And increasingly, these two markets were telling different stories. Paper silver suggested liquidity and easy trading. Physical silver suggested scarcity and hoarding behavior. One of these markets would eventually force the other to adjust. The question was, which one would break first? January 9th represented a moment when these tensions were visible but not yet resolved. Silver's price drop below $80 reflected paper market dynamics. Profit-taking. Technical corrections, dollar strength. But beneath the surface, physical demand from China remained relentless. The coming months would reveal whether paper or physical markets controlled silver's destiny, whether Western financial engineering or Eastern strategic accumulation determined prices, whether speculation or industrial reality mattered more. China was not making predictions about silver reaching $100 or $175. Chinese institutions were making calculations about strategic advantage, industrial security, and monetary alternatives. They were positioning for a future where silver scarcity could provide leverage in ways gold never could, because gold was too expensive for industrial use at scale. Gold was a pure monetary metal. But silver was different. Silver was essential for the technologies defining the 21st century. Solar, electric vehicles, AI, 5G networks, medical devices, control silver supply, and you influenced the pace of technological development globally. That was a form of power that transcended simple investment returns. The shift was happening. Most people just weren't watching closely enough to see it. There are moments in economic history when numbers stop being statistics and become warnings. The 5-year supply deficit in silver markets was one of those moments. For 5 consecutive years, from 2021 through 2025, the world consumed more silver than it produced. This wasn't a one-year anomaly. This wasn't a temporary disruption caused by a mine closure or a pandemic. This was structural. In 2025 alone, the deficit reached 63.4 million ounces. To put that in perspective, that represented nearly 8% of total annual global production simply vanishing from available supply. Forecasts for 2026 showed the deficit would continue, though perhaps narrowing to 30.5 million ounces. Still a deficit, still structural, still unsustainable over the long term. The question business leaders needed to ask wasn't whether this would resolve. The question was how it would resolve. Mining companies couldn't simply flip a switch and produce more silver. The economics of silver production created constraints that most investors didn't understand. Approximately 70% of all silver came as a byproduct of mining other metals: lead mines, zinc mines, copper mines, gold mines. When a company operates a zinc mine, silver appears as a bonus, a welcome addition to revenue, but not the primary target. When silver prices rise, these companies don't automatically produce more silver. They produce more zinc. The silver output barely changes. This meant traditional supply and demand mechanics didn't function normally in silver markets. High prices couldn't easily call forth new supply. Mexico's situation illustrated this reality perfectly. New environmental and labor regulations implemented in 2024 and 2025 had reduced output from some mining regions by approximately 5%. This supply reduction hit global markets just as demand was accelerating. That 5% might sound small, but in a market already running deficits, every percentage point mattered. And even if companies wanted to open new primary silver mines, the timeline was brutal. From discovery to production, a new mine typically required 7 to 10 years. Exploration, permitting, infrastructure development, capital raising. By the time new supply could reach the market, the structural deficit would have persisted for over a decade. The United States government recognized this strategic reality in 2025. For the first time, they officially designated silver as a critical mineral. It joined rare earth elements and lithium on the list of materials essential for national security and economic competitiveness. This wasn't symbolic. Critical mineral designation meant government policy would prioritize silver availability. It meant potential export restrictions during supply crises. It meant silver had transformed from a precious metal investment into a strategic industrial commodity. The technology dependency matrix revealed why this designation mattered. Solar technology was fundamentally locked into silver use. Silicon-based photovoltaic cells required silver paste for electrical conductivity. Scientists had searched for decades for adequate substitutes. Copper worked in some applications, but not at the efficiency levels required for competitive solar panels. The global renewable energy transition wasn't optional anymore. Governments worldwide had committed to carbon reduction targets. Those commitments meant billions of solar panels over the next decade. Each panel needed silver, period. The automotive industry faced similar constraints. The transition from internal combustion engines to electric vehicles was accelerating faster than most forecasts had predicted. Every electric vehicle required significantly more silver than traditional cars. Autonomous driving technology added another layer. Self-driving vehicles needed extensive sensor networks. Each sensor required silver for reliable performance. As autonomous features became standard rather than luxury options, silver demand per vehicle would only increase. 5G network infrastructure was consuming silver at rates that surprised even industry insiders. Every 5G base station required silver for connections and components. As telecommunications companies rolled out 5G coverage globally, Thousands of base stations were being installed monthly. Medical devices represented another locked-in demand source. Silver's antibacterial properties combined with its electrical conductivity made it irreplaceable in certain medical applications. From wound dressings to diagnostic equipment, silver played roles that couldn't easily be engineered away. The artificial intelligence boom created perhaps the most explosive demand source. Data centers powering AI models required massive amounts of silver, not just in servers, but in cooling systems, power distribution, and backup infrastructure. Every major technology company was racing to build AI capacity. Microsoft, Google, Amazon, Meta, Apple. Each announced multi-billion-dollar data center investments. Each data center translated directly into silver demand measured in tons, not ounces. The technology roadmap from 2025 to 2035 effectively locked in silver demand growth. These weren't speculative uses that might materialize. These were existing technologies scaling to global deployment. Industry could not engineer around silver scarcity in these applications. Not quickly, not cheaply, not at the scales required. This created a situation rarely seen in commodity markets. Predictable, growing demand meeting constrained, inflexible supply. January 9th marked an inflection point in this structural reality. The price drop below $80 represented paper market mechanics, technical corrections, profit-taking, normal volatility in financial markets. But the physical market told a different story. Shanghai's inventory depletion continued. Lease rates remained elevated. Delivery challenges persisted. Industrial buyers competed more aggressively for available supply. Three certainties emerged amid the uncertainty. First, the structural deficit would continue. Mine supply couldn't increase fast enough to close the gap. Industrial demand would keep accelerating. The math was simple and unforgiving. Second, industrial demand would intensify. The technology transitions underway weren't reversible. Solar deployment would continue. EV production would grow. AI infrastructure would expand. Each trend independently supported higher silver demand. Together, they created unprecedented consumption growth. Third, strategic accumulation would persist. Whether acknowledged publicly or not, nations understood silver's strategic value. China's actions suggested a long-term accumulation strategy. Other countries would likely follow similar paths if they hadn't already begun. For business leaders and entrepreneurs, these certainties created both risks and opportunities. Risk scenarios included supply chain disruption, price volatility, and availability constraints. Companies dependent on silver inputs needed strategies for managing these risks. Longer-term supply contracts, strategic inventory positions, alternative supplier relationships. The opportunity framework was equally clear. Industries positioned to benefit from silver's role in emerging technologies stood to gain. Mining companies with primary silver production would see improved economics. Technology companies that secured reliable silver supply chains would have competitive advantages. What entrepreneurs and business leaders needed to monitor going forward was specific. Physical premiums over spot prices. When actual metal trades significantly above paper prices, it signals physical scarcity. Delivery times. When wait times for physical metal extend from days to weeks, supply chains are stressed. Exchange inventory levels. When Shanghai, London, or New York inventories decline, physical metal is being removed from circulation. Policy changes. When governments designate materials as critical or implement export restrictions, markets shift quickly. The preparation window was narrowing. January 9th sent a clear signal. The market was recalibrating. Structural forces were building pressure. The question wasn't whether change was coming. The question was who would be positioned to benefit when it arrived. Those who waited for consensus would find themselves responding to changes rather than anticipating them. By the time major institutions agreed on silver's trajectory, the strategic positioning window would have closed. Markets reward those who see structural shifts before they become obvious. Silver in early 2026 represented exactly that kind of opportunity. A 40-year pattern had broken. A 5-year deficit was intensifying. Industrial demand was accelerating. Strategic accumulation was underway. The signals were clear. The question was who was receiving them.